In this presentation, we will take a look at the partnership type of organization, introducing the topic of partnerships. For more accounting information and accounting courses, visit our website at accountinginstruction.info. First, a definition. A partnership is an unincorporated business with two or more owners to pursue profit. So, like any type of business entity, the main goal when we think of an accounting perspective is the pursuit of profit. We're looking to earn revenue, that being the goal of general business in general. The partnership type of organization will have two or more individuals involved. And you can think of it as close to, or at least the general partnership, close to a sole proprietor type of organization, whereas you have an individual looking to gain profit, partnership, two or more individuals with that same goal. Those are really the only two characteristics that are involved to make something a partnership. Meaning, if two individuals get together and they start to act in such a way that they are pursuing profit, doing business type of activities, they are then, by default, a partnership. This is, of course, similar to the idea of a sole proprietor who, if we start to just engage in activities that were to pursue profit, that in and of itself is, in essence, a sole proprietor. Both partnership income and then sole proprietor income, then the IRS would like to have their share of them and be reported to them in terms of taxes as well. If we think about other types of entities, in particular a corporation type of entity, then that's going to have more involved in it in order to create that type of entity. One reason because the corporation is a separate legal entity, whereas the partnership is going to be us pursuing profit, and really all it really takes to get that general partnership is acting in such a way to pursue profit. So we could have different types of characteristics of the partnership, one being a limited life. Now we're talking here about a general partnership. So if two partners get together, they start doing business, there are some characteristics. One is a limited life of the partnership, unlike, say, a corporation, which could have life beyond the partners, meaning at some point in time, of course, the partnership will terminate, especially at the point in time that a partner deceases, if not before. Whereas a corporation could inherently live beyond the partnership, beyond the corporate owners or the shareholders, because it's a separate legal entity. So that's one of the pro, you can think of that as a pro or a con of a partnership, is that it has that limited life. It's got partner liability in a similar fashion as a sole proprietor. And that's usually the biggest downfall of just a normal general partnership, is that you have this kind of liability, whereas if there's a problem with the partners, or if the company gets sued or something like that, there's less ability to have a wall, a barrier between the partnership and personal assets, meaning individuals could then go after personal resources for the partner if something happened within the partnership, as opposed to, or would be more difficult to do that if we had a separate legal entity, something like a corporation, where if someone sued the corporation, then typically they can go after the assets of the corporation, not so easy to go after the assets of the shareholders of the corporation. So then we have a flow-through entity in terms of taxes. And this could be a pro or a con as well. Flow-through entity, it's often a pro, is that the money is going to go through the partnership return and go to the individual partner. So in essence, the partners will report their share of profits on their Form 1040 rather than a separate return having to then report and pay taxes at the partnership level. This too differs from a corporation which will have to report profit on the corporate level, and then that could result in double taxation. So this is actually often a benefit of the partnership, to have a flow-through entity. It could be a benefit, especially to smaller partnerships. There's also going to be mutual agency. And this is a problem that could happen in terms of partnerships, or it could be a benefit as well. But once we have the resources that are in the partnership, either partner or any partner can then make binding contracts about the current resources or future liabilities. And those binding contracts now, because they're acting as an agent of the partnership, become binding to the others as well. And that's something to really be careful of, because once we get into a partnership, our the assets we put in as well as the liabilities that we could incur as part of that partnership are subject to the actions of others through the agency concept, through any partner acting as an agent of the partnership and therefore being able to in some way make binding contracts with individuals, and in so doing binding the resources of the partnership which are mutually owned. Types of partnership organizations. We're going to go through some different characteristics of the partnerships here, but we also want to keep in mind the different types of partnership organizations to give a quick pro and con of the different types of partnerships and organizations that can be relevant and involved. As we do this, note that when we go to the actual bookkeeping, it'll be very similar. We're going to treat most of these entities in a similar way, but there's pros and cons to having different types of entities. We will default to the general partnership, which is just the idea of two individuals. That's the easiest thing to form. We start doing business together, we become a general partnership. Also want to point out that the sole proprietor, one advantage of the sole proprietor, or something to consider between a sole proprietor and a partnership, would be if we're an individual who's thinking about getting a partner or a sole proprietor, then it has to do with the control of the business. If we were to hire someone or contract someone, then of course that individual wouldn't have that mutual agency. If we were to bring in a partner, it's oftentimes easier to bring in a partner and then collect capital that way. In other words, it's easier to get investments if we give an equity interest in the partnership. But of course, then you have two individuals involved making decisions in the decision-making process. So there is that choice between, if we're an individual that has a business idea, do we want to take on another partner, or do we want to try to contract out or have employees? And that's something to think about in terms of the partnership. Now, if we do get two people together or more and just start doing business, in essence, we are a partnership. IRS is going to basically think of us as a partnership. We're going to have to report our income and in that format. Then if we're a limited partnership, another type of partnership entity, in this case, we have at least one limited partner and a general partner. And these are really beneficial if we think about investments. Note that the partnership interest, one advantage of a partnership over a sole proprietor is that if we provide an equity interest to somebody else, they're more likely to give an investment in the company, that would be, or in the partnership. And so the other thing that could attract investors if we need capital in order to get our partnership going would be that if we give them limited liability, meaning if someone else is not involved in the partnership, but they want an equity interest in the partnership, and they're a limited partner, they could put money in the business and not worry about getting sued, and they losing not only their investment, but someone going after their personal resources. That's going to be the major benefit of a limited partner. You can have an equity interest from an investor type of person who's not involved in the day-to-day operations typically, who can then get profits, but not the risk of losing more, hopefully, in general, than their investment. And in that case, usually the general partner is acting more as an investment type of individual and not involved in the day-to-day operations, and the partners or partner that is involved in the day-to-day operations then has more liability in terms of their personal assets, meaning they can lose their investments, and it's likely possible that someone can go after their personal assets as well. Then we've got the limited liability partnership and limited liability companies. And these are going to be similar in nature in that they're both looking to find the best of both worlds in some way between a corporation and a partnership. Partnerships are very flexible. So to set up a partnership and set up the organization for the partnership and to set up how the profit sharing will happen, you've got a lot of flexibility to decide that. And that's a great tool between partners because you can negotiate exactly how you want the partnership profit sharing to be and different other areas within the partnership. And it's a flow-through entity, and that means that it only gets taxed at one time at the partners level, not at the partnership level. Whereas the corporation, you have less flexibility. All the shares have to be the same. So, you can have more or less shares, but it's a little bit more difficult to have profit sharing or different type of allocations of income. You got a lot more flexibility in some cases in a partnership type of organization, and you have the huge problem of double taxation, meaning if a corporation is a separate legal entity, then they also need to be taxed as a separate legal entity. And we know that they're going to get taxed as a corporation, also being taxed when the dividends are paid to the owners. So that means that the corporation is going to be taxed in two different components. The partnership, or the LLC and the LLP, are an attempt to have a limited liability, to put in that limited liability shield, and still be a flow-through entity to eliminate the double taxation. So the accounting for them will be much the same. It'll be very similar to the partnership type of accounting. In essence, we're looking to act like a partnership and still get some of the benefits of that corporate type of organization, that separate entity. Here's just a brief recap of the types of business entities and some characteristics of them. We won't go into a lot of detail of them, but we need to note that there are these different entities, and they can be really confusing when we first start thinking about how we're going to organize our business. And they're very important to pick the right entity when we organize our business. But there's a lot of similarities to them as well. So there's similarities and differences in the different types of organizations. So we've got the sole proprietorship, we've got the partnership, we've got the LLP, the LLC, the S corporation, and the corporation. Now note, we're focusing here on the partnership, and the partnership and the LLP and the LLC will function similarly when we do the bookkeeping. Note that all of the types of entities will have, most of the bookkeeping basically the same, meaning if we pay the utility bill, if we, pay our employees, that kind of stuff, all the normal type of journal entries will remain the same no matter what type of entity we are. Where will they differ is where we will spend our time, meaning the sole proprietorship obviously has one partner or one individual, one owner, whereas the partnership has two or more. So that's where we're going to spend our time. Our time's going to be spent on where's the profit sharing going to happen, what's going to be the split on the profit sharing, how are we going to know how much of the company these two owners own, which will deal with their capital accounts. The LLP and the LLC is going to be accounted for in a similar way as the partnership. And so these two, from an accounting standpoint, we're going to be focusing in on the same type of entries here. The S corporation is another attempt to be to have partnership and corporation type of characteristics, but leans a little bit more towards the corporation type of entity, but still has that flow through process for the income to flow through to the individual, eliminating the double taxation. In other words, doesn't quite have as much flexibility as the partnerships for profit sharing agreements and that kind of thing, but still has that flow through process for the S corporations. And the decision between these three also can depend a lot on the states that we're in and what kind of state regulation. And then we have the corporation, and the corporation, what's going to differ within the corporation, again, it's going to be the equity section for the most part, because normal transactions are going to be the same. They all still pay the utility bill. They all still pay their employees. What changes? Well, now the equity section is going to be comprised of not one sole proprietor capital account, not two partnership or more partnership accounts, but stockholders. So stockholders are how we're going to have to organize the corporation. So just note what's the similar and what's the difference between these types of organizations. Note that any one of them, if we learn the accounting, most of the accounting is the same. Note that when we concentrate on these types of organizations, we are concentrating on the areas where they're different. And that could lead us to believe that they're completely different, because that's where we're spending our time, on the things that aren't the same. But that's not really the truth. They're really much the same. And we, of course, need to spend our time in those areas which differ. Okay, so the legal entity. The proprietorship is not a separate legal entity, meaning it's a separate business entity. We'll keep the business separate from our personal books, but it's not a separate legal entity, and therefore doesn't get that liability protection as a separate legal entity. So it's important to get those two things, straight. We account for the books, of course, for any type of organization as separate than our books. But from a legal perspective, the corporation is going to be a separate legal entity. In essence, we're giving the corporation human characteristics, like they can own property and pay taxes. Whereas the partnership is a flow-through entity and is not considered to own the property. If we buy something for our proprietorship, it's really kind of, we bought it. It's still kind of our thing that we're applying to our business. And we're keeping the wreckage separate, but not really putting it into a separate entity. We can't really say that our business, owns it in the same sense that we can with a corporation. Partnership is the same. There's no separate legal entity there. The LLC, the limited liability partnership, is also not a separate legal entity, and that's going to try to address some of these problems that usually often are addressed with the being of a separate legal entity, but it does so here by having a partnership who's a limited partner, at least one, and that would eliminate some of the liability type problems. Then we have the LLC, and this is going to be a limited liability company. And this is going to be an entity that attempts to get the best of both worlds in many cases between the partnership and the corporation, meaning the corporation being a separate legal entity can help to have liability protection for the partners. And so it's trying to get that liability protection to have more liability protection by being more of a separate legal entity. And that's really the driving factor for liability protection, or one of the key components that would allow for liability protection, but still have some of the characteristics of the partnership. One major one being that it remains a flow-through entity and therefore is taxed only one time at the individual level rather than at the business level and then at the individual level. So those are the trying to meet in the middle. Then we have the S corporation also doing the same thing, trying to mix the partnership and the corporation characteristics, leaning a bit more toward the corporation, but still trying to get the benefits of being a separate legal entity, the main one being that we have liability protection, as well as having some of the benefits of a partnership, the main one being that we have a flow-through entity and therefore reduce or eliminate the double taxation. And then, of course, we have a corporation, which is the classic example of a separate legal entity. So really, you think of the spectrum. We have a sole proprietor and a partnership, a general partnership, which are not separate legal entities. And then on the other side of the spectrum, we have the corporation, which is a separate legal entity. And then we have the problems with the corporation being that there's a liability problem, main problem. And the problem with the partnership being, the problem with the corporation is that there's a double taxation problem. Problem with the partnership is that there's a liability for personal partners problem. And then these three in the middle are attempts to solve some of those problems. And one of the ways to do that is to be a separate legal entity, but still be a flow-through. Then we're going to look at the limited liability, which ties in some ways to whether or not they're a separate legal entity, meaning the partnership and the sole proprietors are not separate legal entities, and therefore they don't have the same kind of protection personally from their personal assets from some type of a lawsuit or something like that. Whereas if they were a separate legal entity, then they would have some protection between their personal assets. The limited liability partner, we have the limited partners then would have liability protection because they're not involved in the partnership directly. Therefore, you can't go after their personal assets in the same way that you can with the general partners. The LLC, being a separate legal entity, also has limited liabilities, so a benefit for the owners of the LLC. S corporation, being a separate legal entity, also has the benefit of like a corporate shield, so that you can't go over the assets of the individuals, the owners. And then, of course, the corporation also a limited liability for the owners of the corporation. Then we have the business tax. The sole proprietor and partnership are not taxed as a business, meaning they're flow-through entities or taxed on the individual returns. And this, again, falls to or relates to whether or not they're a separate legal entity or not. So because these are not a separate legal entity, they don't pay on the taxes on the business level. Now, the other side of this is the corporation, which of course will pay taxes. And then these three in the middle, what they're trying to do is be more of a flow through. So they're trying to be like a corporation, but eliminate the business tax. So these ones actually do not pay taxes on the business level as well, even though they're closer to a corporation, meaning this is a limited liability corporation, this is an S corporation. So they may have reporting responsibilities, but not pay taxes on, at least for the Fed, on the corporate level, but rather flow that information, flow that tax debt to the individuals who would then pay on their 1040s, and that saves the double taxation problem. The corporation then would pay the separate business tax. That's the main problem with the corporation, because it can result in double taxation, as the corporation files their return and pays taxes, then pays the individuals in forms of dividends, and the dividends are currently taxable as well. For more accounting information and accounting courses, visit our website at accountinginstruction.info.